Hello, everybody, and welcome to the Like Totas channel. Happy Tuesday to every single one of you, dear viewers. If you are new to the channel, welcome, and if you are not, thank you so much for sharing the word. And because the number of subscribers continues to grow, and that means you are doing your best to spread the word, and that's exactly what we ask every single time we put a video out, and provided you are gaining value from it. So, guys, today I want to talk about this SpaceX IPO, and whether or not the projected market cap is makes sense. So I want to talk about some of these fears around a potential AI bubble, whether or not I think they are justified, in how exactly we, tortoise kind of investors, can protect us from any downturn that we may see in the markets. And the reason I say that is because if there is indeed a bubble, and if the bubble does pop, then everything will come crashing down. Yeah, of course. I mean, the most speculative names, certainly many of them will go to zero, but as you already know, we are not in the business of predicting what the market will do over the next few months. We are in the business of selecting the highest quality type of companies that can survive, not only survive, but thrive after the dust is settled. And so let's first start by addressing the SpaceX IPO. In what exactly are my thoughts on that? And the reason I want to discuss this is because I was on a coach session call with one of our partners. I always call you guys partners instead of clients. I don't like the word clients, but you was asking me a very, how can I say, a very understandable question. He was saying, but Ed, even if the IPO, so even if they list the shares in the market cap comes up to 1.75 trillion, then of course investors are already, a lot of growth is already built in that valuation, but then they are assuming that the company will generate a lot more revenues down the line. And so he was asking this, and it makes sense. So in other words, because the company could deliver so much more revenue in profits down the line, then it makes sense perhaps to pay a hefty price today. Okay, so this is what I have to say. And as always, I did some digging, but I want to make this video short and punchy at the same time to drive the most important thought home. And that's exactly what I did. And so I'm going to share this with you right here in this Word document that I prepared in the lead up to this video, and you guys can understand a bit more where I'm coming from. Right. So SpaceX is as reportedly on the verge of going public. Shares are expected to begin trading on June the 12th in what could be the largest public offering in history. What's even more interesting is that this coincides with several other companies going public, namely ChatGPT and even Claude AI. In fact, I think Claude AI is already listed. I'm not entirely sure, but I think I heard something about that. And I think the valuation hovers 1 trillion, something like that. I mean, this is incredible. So now this is where things get a bit more interesting. And this is what I was sharing with that partner of ours, while on a call with him. According to estimates, SpaceX is looking to raise between 75 billion and 80 billion at a staggering 1.75 trillion valuation. So when I mentioned $1 trillion valuation, I actually fell short. It's actually 1.75 trillion, closer to 2 trillion. Unbelievable. Now, this is where things become more interesting. The company operates across three core business segments, which together generated about 18.7 billion in revenue. This is the revenue that the company generated in 2025. Despite this impressive top line growth, and I think they managed to grow revenues year over year at around like 30%, which is very, very good. I forgot to mention that here. But anyway, so what I would say, despite this impressive top line growth, SpaceX reported net losses of 4.9 billion as it continues to invest aggressively across all these three divisions. The cash flow statement paints an even more striking picture, and because they will be publicly listed, right? So they will be listed. You will have access to the financials of the company, and you can already look them up, and you can see and like the income statement, the balance sheet, and have a look at it, and you will find exactly what I'm sharing here with you. During the first quarter of 2026 alone, SpaceX spent 10.1 billion on capex, while generating just 1 billion in operating cash flow. So they generated 10 billion in capex and only 1 billion from the operations of the company. In other words, the business burned roughly 9.1 billion in cash in a single quarter. This is not, it's not like SpaceX is a money-making machine. It's exactly the opposite. They are bleeding a lot of cash to sustain all of this revenue growth. Now, this is something that you have to understand, because many of you may already be thinking, oh, Ed, but some companies in your portfolio, like Alibaba, for example, they are bleeding cash as well. No, 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 no. Alibaba generates a lot of free cash flows. The company is very profitable, generates a lot of free cash flows, and the reason they are in that position is because they are so it's self-inflicted. They are investing back into growth, but if you look at the balance sheet, they still have several billions in cash. This is polar opposite. SpaceX is in a completely different universe. This is a company that does not make any money, everybody. It's important to understand the difference. In fact, not only don't they make money, they are losing a lot of it. At a $1.75 trillion valuation, SpaceX would be trading at more than 100 times 2025 revenue and approximately 300 times adjusted EBITDA. What's particularly remarkable, pay attention to this as well, what's particularly remarkable is that companies with similar market capitalizations, and you know their names, right? So the likes of Meta, Amazon, they are already highly profitable, mature businesses. They have well-established business models. They have been around through different cycles, and they generate tens of billions of dollars in annual earnings and free cash flow. So the question that you, as an investor, should ask yourself is, do you think SpaceX is generally worth 1.75 trillion, or are we witnessing another period of extreme market euphoria? And of course, I was reading some headlines on the subject from different sources, and several investors seem to agree with me. They see a bubble in this stock, and again, you can read that here. The dot-com bust shows why mega IPOs might mark the peak of the stock boom. Tesla stock slips overnight. SpaceX IPO hype is starting to look like Amazon's dot-com bubble. British investors, while the SpaceX IPO put this. So what I'm saying here, guys, is that you have to understand something. Just according to what Warren Buffett, and I think this is one of the most important quotes for us long-term investors: price is what you pay, value is what you get. What investors are paying for each share of SpaceX today doesn't have any margin of you don't have any margin of safety in case these exuberant expectations don't end up materializing. And this is where the problem is. Guys, we are talking about a company trading at 100 times earnings is already crazy. Only in this market will you find companies trading at 100 times earnings. In fact, let me show you some of them. I'm not sure if this is still the case, but I'm guessing they are probably not that far off. So let's check, for example, a company like Palantir. Palantir is trading at 180 times current earnings, and they are trading at 101 forward earnings. This is unbelievable. It can only be seen in a market, in an environment like the one we are seeing today. What this means, guys, in very simple terms, is that if you buy Palantir shares today, then you would have to wait 180 years to get your money back from earnings, assuming those same earnings, the earnings they are generating today, remain flat. So, assuming they don't grow earnings. Now, you can say, of course, they will grow earnings. They have been compounding earnings attractively over the last several years. Then, in fact, if I go right here to financials, and if we go to trailing 12 month, in fact, let's switch this to annual. Yeah. So if we go right here, you can see how fast that earnings per share growth is exploding. Now, the question, what I'm challenging you to do here, my pushback is, do you think there is a lot of optimism priced into this stock? Investors are obviously discounting meaningful growth over the next few years. But what happens if that growth doesn't materialize? If it doesn't materialize, ladies and gentlemen, what can happen is you have a situation like we saw back in the 2000 tech bubble with Microsoft. And I keep showing this chart to my clients and also to several of you to drive this point home. Let me show you where is this, where market valuation and concentration, it's right here. So this is what we are seeing right now. Yeah, so this is what we saw back in 2000. You can see that Microsoft for 16 years did absolutely nothing. And all the while, if you go back and check the revenues and earnings from 2000 to 2005, for example, you can see that the company continued to improve its fundamentals. However, the price that you were paying in 2000 was egregious, right? Because in 2000 you were paying several times the company's current earnings, and even though the company went on to deliver everything that they promised to deliver, I mean, that didn't stop that didn't stop the stock to remain flat for 16 years, because the price you were paying made no sense. And I believe we are right now living through one of these situations where several of these companies, you will probably have to wait decades to break even. And what's going to happen, of course, do you think that those investors who bought Microsoft in 2000 waited 16 years without selling their position? No, that is just a minority. It's not how it works. In all likelihood, they ended up selling shares of Microsoft to buy something else. And so this is what I mean. In situations like that happen several times. In fact, for example, PayPal is another very good example. I'm going to show it. I'm going to show this to you. In full disclosure, I'm invested in PayPal, as you guys know. But take a look at the valuations of the company back in 2001, and then the rest is history. So this is annual, as you can see. Let's check out the ratios right here. Yeah, they have always been a free cash flow machine, but the earnings have also been very consistent over time. So if I check the price to earnings ratio, take a look at that. At one point in December 2021, the PE was at 53, and it was even higher around 2000. Again, where is the margin of safety? And then you know what happened? The moment the company faced headwinds, then the stock didn't come down 10 or 20%, it came down 75%. And this is what we don't want to happen, especially when we run a concentrated portfolio of high quality, high conviction names. We must make sure that every single company we put our money in has a margin of safety, because by far the most important thing is we have to protect our capital. Every investment decision we make must be in order to avoid any permanent loss of capital. And if you read the book by Seth Klarman called Margin of Safety, then this is exactly what you will find. Permanent loss of capital is where the risk lies, not volatility. Volatility is not risk, but permanent loss of capital is. Howard Marks said that, by the way, another very famous value investor. So, yes, going back right here to the point that I was making about SpaceX, I would never ever buy shares in this company. And because if you are because you, for especially those of you who have already subscribed to the channel, I assume that what I say resonates with your philosophy, with your values, and so I assume that you would never put your hard-earned money into a company like SpaceX. Again, this is nothing against Elon Musk. I think the guy is a genius, but I also think he's very good at creating euphoria, and we continue to see that with Tesla. I mean, Tesla is a stock that even it's a stock that is built on promises. Yeah, and of course, it's like you can't use standard valuation metrics to put a value on a company like Tesla, apparently, because they always defy logic. That doesn't mean, obviously, that I will be paying that I will be buying shares in this stock, because of course it doesn't meet, number one, it doesn't meet my criteria for quality. That's the first thing. Number two, it certainly doesn't meet my criteria for cheapness. And so again, I think in the next bust, and it will happen, like a tortoise type of investors will not only make a lot of money but actually thrive, because while, or even in a sideways market, this our strategy will continue to deliver superior annual returns. And because there are still many companies in pockets of the market that remain very cheap relative to their history, in relative to the S&P 500 index as a whole. And I think this is where you should attack, provided you understand the companies. And like I said, I continue to see many opportunities. In fact, I believe most companies in my portfolio, in the Leica Totus portfolio, remain cheap relative to their fundamentals, and that doesn't stop us from compounding money either. But what it does is, in the event of a market decline, then we already have a cushion against that downside, because we own quality and cheapness. Both of these combined will set you up for financial success over the next several years, regardless of the market conditions. But this, what I'm seeing, this stuff like that, this is a company that is losing money, and it's all built on promises that the company in the next few years will eventually turn the corner to profitability, and then you will get rewarded. Guys, this is not the type of investment that we are after. So I just want to make my point clear here. This is full hype, just complete speculation, and it's very opposite to what a sound a sound investor should do. The goal for us is to protect our capital while making sure we build stakes in quality businesses. And you don't have neither of those here. You don't have a margin of safety, and you certainly don't have quality, because the company is still losing a lot of money. And look at this. They are spending 10 billion on capex while the operations of the company only bring in 1 billion. Where is the rest of that money coming from to fuel those capital expenditures? They are either borrowing money directly from the banks, or they are diluting existing shareholders. And anyway, I just I don't like that. This is absolutely incredible. So yeah, this is what I wanted to say, guys. Sorry if the video got a bit longer than expected. But if you like this video and if you agree, even if you disagree, by all means, let me know in the comments. And yeah, and let me tell you, let me ask you, are you planning on buying shares whenever they become available, or is this a stock that you would simply stay away from? Very curious to hear your thoughts. Thank you, everybody, and speak to you soon. Remember, be a tortoise.